SpaceX told investors their mobile satellite market is worth $740 billion. Their actual 2025 revenue from that market was $632 million. The gap between those two numbers is either the biggest opportunity in telecom or the most expensive story ever told to Wall Street. And knowing which one it is depends entirely on a metric that almost nobody is talking about. If you are the kind of investor who manages your own portfolio, reads the filings, and does not trust a headline number without running it back to the source, this one is worth your time. Because the S1 SpaceX dropped in May 2026 buries the real thesis 4 layers deep, and most of the coverage is not getting there. Today we are going to do the math that the prospectus hopes you skim past. We are going to separate the story SpaceX is selling from the infrastructure SpaceX is actually building. And by the end, you'll have a 3-step framework for evaluating any direct-to-sell investment thesis, not just this one. Before we get into the numbers, if you want more breakdowns like this where we pull apart the actual filings instead of summarizing the press release, subscribe to the Paycheck Lab. It is the best use of 30 seconds you will spend today. Now let's open the prospectus. The first thing you see when you look at SpaceX's mobile satellite ambitions is that $740 billion TAM, total addressable market. It is a massive number, and it is printed right there in the S1. If you are reading quickly, it looks like validation. It looks like SpaceX has identified a prize and is going after it. But satellite analyst Tim Farrar of TMF Associates flagged something in that number immediately after the filing dropped. The $740 billion TAM is calculated by taking the entire global wireless market, all of it, including 8 billion mobile devices that are already connected to existing cellular networks around the world. Devices with full bars, full coverage, no reason to look at a satellite. That is not a total addressable market. That is a total existing market. The difference matters enormously. A TAM is a realistic slice of demand your product can actually capture. What SpaceX put in that prospectus is closer to the sum of every dollar spent on mobile connectivity on Earth, as if every subscriber in Seoul and London and Chicago might one day route their calls through Starlink instead of a cell tower. Farrar's response was direct. There is nothing in the filing that suggests SpaceX has a credible path to competing with terrestrial networks in areas that already have coverage. So let's set aside the $740 billion and ask a simpler question. What did Starlink Mobile actually earn in 2025? The answer is buried in the S1. It is $632 million. That is what I call the revenue gap. $740 billion on the cover, $632 million in the income statement. The ratio between those two numbers is roughly 1,170 to 1. For context, if you told someone you were going to sell $1 billion worth of lemonade and then you sold $855,000 worth, you would not describe that as early innings. You would describe that as a different business than the one you pitched. Now, $632 million is not nothing. It is real revenue from a service that did not exist 3 years ago. But it matters what direction the unit economics are moving, and here is where the filing delivers some uncomfortable data. Starlink's average revenue per user, what the industry calls ARPU, has been falling fast. In 2023, it was $99 per month. In 2024, it dropped to $91. In 2025, it was $81. In the first quarter of 2026, it hit $66. That is a 33% decline in roughly 2 years. The company is bringing in more devices but extracting less money from each one. Imagine a bar on the left side of a graph representing that $99 ARPU from 2023. Now watch it shrink. Year 1, it drops to 91. Year 2, it drops again to 81. By Q1 2026, it is at 66, barely 2/3 of where it started. The bar is not growing. It is compressing. And you are building a business case on top of it. The S1 frames this as a deliberate strategy. SpaceX is pushing into lower-income geographies and lower-tier consumer plans to drive subscriber scale faster, accepting weaker per-unit economics now in exchange for market position later. That is a legitimate strategy. Amazon did something similar with AWS pricing, but it requires the second half of the thesis to be true. It requires the scale itself to eventually become the moat. So here is the right question. If the revenue today is modest and the ARPU is declining, what exactly is SpaceX building that justifies serious investor attention? This is where I want to stop looking at the income statement and start looking at the balance sheet moves. Because the real story in this filing is not in the revenue line. It is in what SpaceX spent $19.6 billion acquiring. In September 2025, SpaceX announced it was buying EchoStar's AWS-4 and H-Block spectrum licenses for approximately $17 billion. $8.5 billion in cash, $8.5 billion in SpaceX stock. 2 months later in November, they amended the deal to add EchoStar's unpaired AWS-M3 licenses for another $2.6 billion in stock. Total spectrum acquisition, roughly $19.6 billion. This is what I call the spectrum moat. And understanding it is the difference between reading this filing as a tech story and reading it as a telecom infrastructure story. Spectrum is not a feature. Spectrum is a finite physical resource allocated by the federal government. You cannot manufacture more of it. You cannot replicate it with better software. AWS-4, H-Block, AWS-3. These are specific radio frequency bands that allow signals to travel through walls, across geography, and directly into the phones already in people's pockets. When SpaceX spent $19.6 billion acquiring this spectrum, it was not buying a product. It was buying the raw material that the next generation of direct-to-cell satellites will run on. Here's why that matters structurally. The V1 mobile satellites SpaceX operates today, the roughly 650 already in orbit serving those 7.4 million devices, are limited in what they can do. Right now, TS Satellite through T-Mobile handles text messaging and location sharing. That is the current capability. The V2 mobile satellites, which require the EchoStar spectrum to operate at full capacity, are designed to deliver broadband data at speeds comparable to terrestrial cell service. They require Starship to launch, and SpaceX says deployment begins in 2027. But the spectrum those satellites will use is already purchased, already licensed, already locked up. Picture two satellite operators side by side. One has 650 purpose-built direct-to-cell satellites already in orbit and $19.6 billion of spectrum lined up for the next generation. The other is targeting 45 to 60 satellites by the end of 2026. That is the actual competitive landscape in direct-to-cell broadband today. AST Space Mobile, the most credible competitor in the D2D broadband space, is aiming for 45 to 60 satellites by year-end against Starlink's existing 650. The Constellation gap is approximately 14 to 1 in Starlink's favor. The spectrum acquisition has no equivalent on the other side. This is a thesis that matters. Not $740 billion in TAM, but $19.6 billion spent on the infrastructure precondition for the next phase, combined with a Constellation head start that no competitor can close in the near term. Now I want to be precise here, because I have seen too many bull cases for this kind of story skip the friction. And if you are managing your own money, you need to know where the cracks are before you decide what to do with them. The strongest bear argument is not about satellites. It is about what satellites are actually being used for right now. T-Mobile CEO Senior Srini Gopalan said at the JP Morgan Technology Conference in May 2026 that satellite represented 0.0002% of T-Mobile's total network usage, concentrated in national parks. His exact words, "Pretty much no one buys satellite standalone." That is not a competitor speaking. That is the anchor partner speaking. T-Mobile is the carrier whose spectrum Starlink Mobile currently uses to operate. If they are describing the service as a national parks feature, that is a data point about current consumer behavior that cannot be waved away. Add to that the urban penetration problem. The SpaceX S1 itself acknowledges that B2 satellites will struggle to penetrate concrete and steel buildings, the dominant architecture of every major American city. The filing also notes that SpaceX does not currently have direct contractual relationships with handset manufacturers, which limits the path to native device integration. An ARPU declining from 99 to 66 over 2 years suggests that the new users coming onto the network are paying substantially less than the early adopters. You can build scale on that trajectory, but you build thinner margins along the way. Here's the conditional truth. The spectrum mode thesis is valid if V2 satellites deploy on schedule and Starship achieves the launch economics SpaceX has projected. If those two conditions hold, SpaceX has built an infrastructure position that will take any competitor the better part of a decade to replicate. If Starship deployment slips, analyst Tim Farrar has noted that launch costs per satellite may not fall meaningfully below current Falcon 9 levels, which changes the unit economics of the whole Constellation build-out. The S1 risk factors, put it bluntly, if full Starship reusability is not achieved, the cost per launch may be as much as $100 million per mission. At that cost structure, the math on V2 deployment gets harder. So neither the full bull case nor the full bear case is complete without the other. That is the honest read. There is one more development worth mapping carefully. On May 14, 2026, AT&T, T-Mobile, and Verizon announced an agreement in principle to form a joint venture. 3 carriers that have competed aggressively for 3 decades, agreeing to pool spectrum resources to build a shared direct-to-device platform. The press release framed it as expanding coverage for underserved communities. But think about what it takes to get 3 fiercely competitive carriers into the same room agreeing to anything. The answer is usually a common threat. They are not panicking. This is agreement in principle, not a closed deal, and it still requires regulatory approval and definitive agreements. But they are moving. When the 3 largest wireless incumbents start pooling resources in a market they have comfortably dominated for decades, that is a signal worth recording. This is not the carriers admitting defeat. It is the carriers admitting the game has changed enough to require a response. Whether their joint venture produces something competitive depends on execution, on spectrum depth, on satellite partnerships, and on a regulatory process that is not yet concluded. But the mere existence of the announcement confirms that the underlying pressure is real. 650 satellites already in orbit are doing something the incumbents cannot ignore. So how do you actually evaluate this as an investor? Here is the 3-step framework. Step 1 is separate the TAM from the SAM. The serviceable addressable market for Starlink Mobile today is not 8 billion connected devices. It is the devices in locations without terrestrial coverage plus the devices whose users are willing to pay an incremental fee for backup connectivity. T-Mobile says the footprint covers 500,000 square miles of U.S. territory. Farrar says actual 2025 revenue was $632 million. Start with those numbers, not the $740 billion. Step 2 is track the infrastructure preconditions. For the V2 thesis to work, you need Starship achieving meaningful reusability, FCC spectrum approvals remaining in place, and V2 satellite deployment beginning on the 2027 timeline. These are observable milestones. Watch the Starship launch cadence. Watch the FCC docket. Watch the first V2 deployment announcement. The thesis advances or retreats based on those data points, not on the quarterly device count. Step 3 is watch the ARPU floor. If ARPU stabilizes somewhere above $70 as lower income geographies reach saturation, the revenue model holds. If it keeps compressing toward 50, the scale story requires volume that the current Constellation cannot yet deliver. The next 2 quarterly filings will tell you more about the trajectory than any analyst note. The revenue gap is real. 632 million against a 740 billion TAM is not early innings. It is a different product addressing a different problem than the one in the headline, but the spectrum mode is also real. $19.6 billion of locked spectrum for a next-generation constellation that no competitor has matched is an infrastructure position that compounds over time, not over quarters. That is the difference between reading this filing as a story about what SpaceX earns today versus what SpaceX has built for tomorrow. Both are true, they just belong on different timelines. And when you put your capital to work, you need to know which timeline you are investing in. One of them is worth the patience. The other is worth the skepticism. The framework above tells you which is which. If this kind of filing forensics resonates with you and you are the type of investor who wants the numbers behind the narrative, hit subscribe. The Paycheck Lab publishes one of these every day. Drop a comment with the one number from this filing that surprised you most. Was it the $632 million in actual revenue, the $66 ARPU, or the $19.6 billion in spectrum? I read everyone. Thanks for watching.